How are we doing? As this is the last session prior to drinks, we're holding all these people back, so we'll get straight into it. Yield is something that investors are focused a lot on. In recent times, there's been a lot in the AFR and other places just about what's going on in credit markets and this massive rush to yield. But we've got a wide range of experts here on the panel. So what I'd quite like to do is just get each of you to introduce yourselves and say a little bit about the funds under management and what you're specifically doing. Tim, perhaps if I could start with you.
Thanks, Chris. Good evening or good afternoon, everybody. My name is Tim Martin. I'm a co-founder of Causeway Asset Management. I think Mike Davis, my co-founder, presented earlier today. Causeway Asset Management's been around in one way, shape or form since about 2002. We're a senior secured lender to the lower middle market space in Australia, sort of typically writing transactions between $2 and $20 million. We probably differentiate ourselves a little bit from the rest of the panel in that we're not a property lender per se. So we're always happy to take some property as collateral, but generally we're looking at corporate lending against business assets. That's a niche space, but it's a space that we've played in for a long time.
Thanks, Chris. Thank you to everyone for having me here. I'm Elizabeth, Head of Property Credit at Aura Funds. Aura is a mid-sized credit fund. We have 4 verticals. We specialise in VC, PE, pref equity, and I look after property. We've got about 1.5 billion under management.
We've got a few spare microphones up this end, so nice. So I'm Chris Carrigan from Quanta Investment Funds. We're a Brisbane-based fund manager. We invest across the risk-reward spectrum, but broadly from core plus style investments up to value add. Typical investment scale for us is between 10 and 50 million. We have 450 active investors that have invested funds between 40 and 20 million. We have a co-investment model, so our management team invests up to 30% of takes 30% of the equity in the trust. Therefore, we're aligned with investors and make decisions as investors as well as the investment manager. That's probably enough.
It's enough. Hi everybody, Craig Bannister from Palace Capital. Palace Capital is a non-bank lender. We specialise in commercial real estate debt and loan sizes sort of $5 to $30 million. We've built up our FUM or assets under management to about $2 billion, which is a little over 300 individual loans. Those loans are funded by high net worth family offices and institutional money that flows through Palace Capital. And the investors, as we'll talk about, are getting these yields. They're getting 10, 11, 12% under first mortgage security and slightly higher under sort of second mortgage debt opportunities. So,
Campbell Newman, Arcana Capital. We're a boutique commercial property fund. It's really a fund of funds with about $250 million worth of assets under management. Been going for 9 years. And our model's particularly single asset, single unit trust, closed-ended unit trust, I should say, which gives people an opportunity really, it's a syndication model.
So I think the key issue that's been brought out recently is about risks. So Campbell, perhaps coming back the other way. So you've got a single asset model in terms of how you run the funds under management. How do you mitigate risks if you have issues with a particular property and a particular asset within the portfolio?
Well, we've got a very exacting process, I suppose. So we're looking, when we make a decision to buy anything, at tenant risk, property risk, sovereign risk, interest rate risk, and we work by consensus. So we don't vote on an acquisition. Everybody's got to agree, and basically it's a partnership between 3 families. And we're always putting our own money in, so that focuses your mind totally. We've got one problem asset, where we had an ASX top 200 company go into liquidation, and we've had to work with our bankers on that and our investors, but we've continued to always service the loan and do what we have to do. So generally it works pretty well. I think the biggest issue at the moment is trying to buy things well. Most commercial property asset classes are overpriced given the very large increase in interest rates. There hasn't been the full reset with a huge increase in rates. We haven't seen the cap rate soften to that same extent.
So there's an issue in terms of the price of assets you see in the marketplace at the moment, and that's a hurdle.
Oh, absolutely. So, I mean, the only thing we're able to buy and really deliver on at the moment is commercial office, and that's because it's so out of favour. And so we've been able to procure some really good deals there, and we think it actually makes sense because suburban office with good car parking ratios, public transport, access to major arterial roads is sought after, is occupied, but CBD is a different kettle of fish. But you've got to convince the investors of that because they've read the AFR and the Australian, and office is just a sea of carnage, you see. So, but it is the buying opportunity if you want yield at the moment.
Thanks. Craig, so your funds are basically under one umbrella, so therefore how do you convince investors about risk? It's obviously on an aggregated basis, and what individual credit problems, how are they dealt with?
Well, it's similar. We also have single asset opportunities, so investors can choose, they can read an IM and then the debt is over that particular asset, or coming through pooled mortgage funds. But the risk for any investor, I think it comes down to if you can look through, see the assets, where's the investment manager investing into, where's the location of that asset, does it make sense to you? We have a lot of investors that invest in single asset loans because they live nearby the asset. They walk around, they see it, they sort of kick the hoardings and say, I'd like to invest into that asset. So I think that's an important part for any investor. If you're speaking to the investment managers, ask, where are these loans located? Is it, what areas or what sectors? We all have expertise, specialty areas, I would call it. In particular, we like development finance, so we're into construction lending. But like that, if you read in the papers, you would probably get a bad idea that construction lending is very risky. Well, depending on your expertise in that space. So it's nuanced, but the best way would be to come and really speak to the investment manager and ask the questions.
Thanks, Craig. So Chris, in terms of sourcing deals for Quanta, where do you see the opportunities, and what are you looking for when you're going after these and to mitigate the risks?
Look, there's that could be a long answer or a short, but look, we see in the order of 200 opportunities a year that come across our desk, and we have a triage process, and some of those are dismissed quickly. But really what we look for is alignment with what our investor mandate is, and then once it does, we establish that it's aligns. We then look to offset risk by trying to look through cycles, future, make sure the assets are sort of appropriate for the future, and by are they flexible in terms of evolving uses of tenants? Can they appeal to a number of tenants? Are they more than just appropriate for their current usage? So that's over and above the very fundamentals of due diligence. And but one thing we really do is try to look through cycles to try and anticipate how appropriate the property is in terms of appealing to future markets.
Thank you. Elizabeth, so again, yours is a broader fund. How do you deal with diversification? How does Aura deal with diversification in terms of having appeal for clients?
Each vertical has its specialist that's heading the role. So for us, it's property. Not dissimilar to Craig's model. We focus on obviously where the assets are located, the leverages, the risk, And for us, it's really important to better understand the clear exit. It's always good to deploy money, but you definitely need to get it back to obviously have our investors feel more comfortable. So working with the investment manager, understanding the diversification nationally, not only the location, but with asset classes and sponsors, and then making sure that the asset and the opportunity meets the investors' risk-adjusted requirements.
Thank you, Elizabeth. So, Tim, you've had wide experience in terms of portfolios and dealing with businesses rather than just property. How do you manage credit risk and as problems arise in the market?
Sorry, that's a good question, Chris. Look, I think the first thing I would say is that diversification is really key, particularly in the corporate lending space. I think you've got to have regional diversity, you've got to have sector diversity. You've also got to look through businesses to see who their counterparts are and who are they doing business with. So not everyone is doing business with, say, Woolworths, or not everyone is doing business with BHP. Great names, but you still want some diversity there. So you've got to break down and look through that. A lot of it comes back to the way that you actually research and find the opportunities, and we would describe ourselves as a control lender. So we want to actually, we'll find the deal, we'll research the deal, we'll structure it, and then we'll manage it. I think that it leads into what happens if you get a problem. I think if you've been through that process, you have a very good understanding of the business. You make sure you grow and build really strong relationships with key employees within the business, particularly on the finance side, but also legal and at board level, and make sure that you're kept up to date. Understand where they are, understand what your exit strategy is, and understand where they sit relative to their competitors. So I think those things are all important. I think making sure that you've got businesses that can actually not just service a loan, but can actually repay it, which I think Elizabeth just highlighted as well. So I think serviceability as well as amortisation are critical. And
what trends are you seeing emerging, sort of coming forward? What changes do you see in the SME business lending market?
Yeah, look, I think the big trend, well, there are two big trends. The first one is private credit or private debt in general. We've been through a particularly sort of strong growth in the number of players and the share of wallet that they're taking away from the sort of the major banks. But relative to sort of global peers, particularly in the US and to a little bit less extent in Europe, we're still a relatively small percentage. So whilst we've been on a growth trajectory, I think we're still in the early stages of that, and I think that's going to continue. So that's the first thing. In terms of the underlying businesses, I think private companies are generally staying private for longer. I think the attraction of going to the listed space, for businesses below a certain market cap, let's say, I'll pull a number out, it's nothing scientific about it, but say $50 million is questionable now. And I think that means that, in many cases, that means they find it even more difficult, particularly if they're not property backed, to access traditional bank type finance. So the addressable market is growing. It's growing, because there are more players, but there are more players as both borrowers and lenders. I think regulation is the other thing that's definitely coming about. I mean, there's been a lot in the press about it recently. There's no doubt that that's just a factor that we all have to live with. I think it's a positive thing. I think gradually, as the market gets more mature, I think we'll continue to get better transparency, better reporting standards, and I think that's where the regulators need to focus.
Thanks, Elizabeth. Trends that you're seeing that coming through in the marketplace now?
When I started, there was 42 competitors in the non-bank specialising in property. We're seeing a lot more fintech and digital platforms streamlining the opportunity for investors for peer-to-peer, targeting, I guess, the lower range of the property sector. We've also seen quite a few of the large players acquiring the smaller funds. So there's more influx of capital coming into the market. So
Good.
it just keeps us on our toes.
Chris, how about you? What are you seeing?
Look, I suppose it's not necessarily a new trend, but I think it's something that is more important than ever is the ability to embrace mixed use in real estate assets, so that whilst an asset may have been originally developed for a certain use, being able to adapt that asset to maximise yield, reduce risk with alternate uses is probably a bit more important than ever. So examples of that is, co-locating good retail with office. You benefit the office by improving amenity. You have shorter lease-up times on your office vacancy. You have better retention of your tenants, and conversely, for the retail, you have a customer base for your retail assets. And we've seen on various assets where we've co-located office, retail and public realm, that we get much better investment performance. So when times are a bit harder and there are challenges and headwinds, I think sort of remaining flexible and agile is more important than ever.
Thanks. Craig?
Just backing up really what Tim was saying, and it's interesting, we are specialising in commercial real estate debt, Tim's specialising in company debt, but the numbers are relatively the same. 15% is currently being funded by the non-banks in Australia, but when you compare that to overseas markets, especially Europe, it's 50%, and in the States, the non-bank sector, which is very wide, would be over 50% of the lending. So that trend is definitely continuing. It's probably strengthening. We're seeing that through deals that are being done recently in the last month. There was 2 listed ASX companies buying non-bank lenders, so circa 1 to 3 billion assets under management. Offshore money, pension funds, sovereign wealth funds are flowing into the onshore managers. And that trend is definitely continuing. They're looking at that from an offshore perspective, looking at the relative stability of real estate in Australia, commercial real estate. Those assets have got a great legal backing, and any funds coming from offshore can easily be hedged. So they're one of the 3 pillars that really underpin the market here. So that capital will continue to flow from offshore. But the beauty about what we're seeing here now in this space is that previously that was the domain of institutional money, taking up all that opportunity. And that's not the case now. The case is that retail investors can play, wholesale investors can also play in that space along with the institutional capital. And that's what everybody along here is really providing the opportunity for investors to pick the sector that you'd like to play in, whether it's private credit under a company or real estate debt-backed assets. But you're getting that opportunity, and these yields are attractive. They're at the 10 to 15% yield mark. But with great security wrapped around it. So it's a good trend, and it's here to stay and will continue.
And Campbell?
Oh, look, I'll just go with something quite different. That's the issue of sovereign risk around Australia. And a number of the state governments have got themselves into very difficult financial circumstances. Victoria is the main one. And as a result, they've responded by deciding they're going to milk the property industry. And that's why, for example, we will not invest in Victoria at all. So when agents ring us, we say, no, thank you, not till you've got rid of that mob. And I'm not just being, it's political, but it's also it's about our business and our investors. And there's an interesting dynamic afoot, because will other state governments go, maybe we can follow Victoria's lead, or will they wake up and see what's happening where there is, I think, going to be an exodus of investment from Victoria through what I've just said? You only have to look at St Kilda Road, which we could say is the boulevard of broken dreams. Going back to what I said about office before, well, there's some bargains there, but when you'll have a tenant and a real opportunity to see value uplift, it could be a long wait.
Well, if all investors take the same approach, then yields will go up, and well then. Okay, so Any final comments? I think we're probably this is a good display of the different varieties of yield that are here. So Campbell, any last
Look,
comments?
just this is a bit left of field, but it's just because we're here. This is the Wholesale Investor Conference, and there has been a quiet battle fought behind the scenes this year for you as wholesale investors, for me as a wholesale investor, with the federal government who are looking to change the criteria for eligibility as a wholesale investor. For the moment, this has been kicked into the long grass. The government decided it's all too hard after a real backlash from VC funds, angel investor groups, the biotech community. And thank God for that, because they were about to do something that had very significant adverse consequences. The UK decided not to do it. The Americans decided not to do it because of those unintended consequences. And I just say, ladies and gentlemen, Steve Torso's played a very important role in that, and I thank him publicly for working on that with people like me this year.
Very true, very true. Any last comments, Craig?
No, nothing's particular.
Chris?
Oh, look, the only thing I'd say is that for as managers and investors, we've had some pretty strong headwinds over the last couple of years, and some pre-existing investments have been a real arm wrestle, and there are investment managers have handled that differently, and some better than others. But it's just good to see that the environment for investing is actually becoming more favourable, and probably the certainty in debt and equity markets is probably going to give a bit of relief to both investors and managers over the coming years. So
perhaps this higher for longer, but at least it's steady and
at least
therefore a little bit more
know.
predictable, so people can make decisions.
At least we know, that's right.
Elizabeth, any
Not
else?
dissimilar. Obviously, the traditional banks are struggling with servicing some of our clients who aren't able to meet their stringent criteria. So us non-bank lenders offer them an alternative to still participating and acquiring additional assets and offering attractive yield for our investors. So,
Thank you. Tim?
Probably a little bit left field, but we often get asked by investors who are coming and potentially looking to invest in credit or private credit for the first time, how should they go? And perhaps perversely, our advice normally starts by telling them that you need to take more than one bet or make more than one bet. So we don't want all of your money, and nobody else should in that sense either. So get diversified, make sure you understand the product that you're actually investing in, and that means you need to read the documentation fairly carefully, because often key features either aren't there, or if they're there, they're actually you have to read carefully to make sure you're there. So understand the docs, understand the money trail, where the money goes, and make sure you're getting paid appropriately for the risk that you're taking. Don't focus too much on really flashy or really high expected returns. Find a business where you understand what they're doing and where you feel comfortable with the people you're dealing with, and I think that's very sensible approach for everybody. Again, we'd love to take 100% of everyone's money, but that's just not realistic, and it's actually not prudent either.
Thanks, Tim. I'd like to ask you all to say thanks to the panel, very diversified panel, and thank you very much. Off to drinks.